Good day, this is the continuation of the discussion for Chapter 8, Operating and Financial Leverage. So the topic that I will discuss is all about operating leverage. I will explain the meaning of operating leverage and how to calculate and interpret the firm's degree of operating leverage. So first, what is leverage? Leverage represents the use of fixed cost items to magnify the firm's results. Operating leverage is a measure of how sensitive net operating income is to a given percentage change in peso sales. Operating leverage is a cost accounting formula that measures the degree to which a firm or project can increase operating income by increasing revenue. Operating leverage acts as a multiplier. If operating leverage is high, a small percentage increase in sales can produce a much larger percentage increase in net operating income. The higher the degree of operating leverage, the greater the potential danger from forecasting risk, in which a relatively small error in forecasting sales can be magnified into large errors in cash flow projections. A business that generates sales with a high gross margin and low variable costs has high operating leverage. So, operating leverage can be illustrated with the use of the following data for two mango farms, green farm and yellow farm. So, dito muna tayo sa green farm. The present sales of green farm is 100,000 pesos and the expected sales is 110,000 pesos. The present variable expenses is 60,000 pesos and the expected variable expenses is 66,000 pesos. So, yung pag-compute ng contribution margin is yung sales minus variable expenses. So, makukuha natin dito is 100 minus 60 is equals to 40,000 pesos. Tapos dito, 110 minus 66 is equals to 44,000 pesos. So, yung present fixed expenses ng green farm is 30,000 and expected fixed expenses ng green farm ay 30,000. So, fixed na yun. Fixed na 30,000. Yung contribution margin minus fixed expenses is equals to net operating income. So, 40,000 minus 30,000 is equals to 10,000. 44,000 minus 30,000 is equals to 14,000. So, dito naman sa yellow farm, ang present sales is 100,000 pesos and expected sales is 110,000 pesos. The present variable expenses is 30,000 pesos and expected variable expenses is 33,000 pesos. So, ima-minus uli natin ito. 100 minus 30 is equals to 70,000 pesos. And the expected contribution margin is equals to 77,000 pesos. Then, ang fixed expenses ng yellow farm is equals to 60,000 pesos. So, ang net operating income natin is 10,000, 70,000 minus 60,000. Tapos dito is 17,000, 77,000 minus 60,000. So next is degree of operating leverage. The degree of operating leverage is a measure at a given level of sales of how a percentage change in sales volume will affect profits. So the degree of operating leverage is computed by this formula: contribution margin over net operating income. The degree of operating leverage is a financial ratio that measures the sensitivity of a company's operating income to its sales. Generally, a low degree of operating leverage indicates that the company's variable costs are larger than its fixed costs. That implies that a significant increase in the company's sales will not lead to a substantial increase in its operating income. At the same time, the company does not need to cover large fixed costs, while a high degree of operating leverage reveals that the company's fixed costs exceed its variable cost. It indicates that the company can boost its operating income by increasing its sales. In addition, the company must be able to maintain relatively high sales to cover all fixed costs. To illustrate the degree of operating leverage for the two farms, Green Farm and Yellow Farm, at 100,000 sales would be computed as follows. So, yung contribution margin ng Green Farm is 40,000 pesos and yung net operating income ng Green Farm is 10,000 pesos. So, 40,000 divided sa 10,000 is equals to 4. While dito sa Yellow Farm, ang contribution margin is 70,000 pesos. Ang net operating income is 10,000 pesos. So, 70,000 pesos divided by 10,000 pesos is equals to 7. So, this means that the Green Farm's net operating income grows 4 times as fast as its sales. In contrast, Yellow Farm's net operating income grows 7 times as fast as its sales. So, dito sa table na ito, if yung sales ng Green Farm and Yellow Farm ay nag-increase ng 10%, then we can expect the net operating income of Green Farm to increase by 4 times or 40%. Tapos sa Yellow Farm naman ay mag-increase ng 7% or 70%. So, alternative approach. Degree of operating leverage, or DOL, is also viewed as the percentage change in operating income that occurs as a result of a percentage change in units sold. So, ito yung alternative approach ng degree of operating leverage. So, degree of operating leverage is equals to percent change in operating income over percent change in unit volume. So, limitations of analysis. Throughout the analysis of operating leverage, it is assumed that a constant or linear function exists for revenues and costs as volume changes. For example, 2 pesos was used as the hypothetical sales price at all levels of operation. In the real world, however, the firm may face price weakness as an attempt to capture an increasing market for the product is made, or it may face cost overruns if there is movement beyond an optimum size operation. Relationships are not as fixed as have been assumed. So, illustrative case 8-2 operating leverage / CBP relationship. Voltar Company manufactures and sells a specialized cordless telephone for high electromagnetic radiation environments. The company's contribution format income statement for the most recent year is given below. So, ang sales ng Voltar Company with 20,000 units is 1,200,000 pesos. Ang variable expenses is 900,000 pesos. So, 1,200,000 pesos minus 900,000 pesos, makukuha natin yung contribution margin na 300,000 pesos. Tapos, ang fixed expenses is 240,000 pesos. Contribution margin minus fixed expenses is equals to net operating income. 300 minus 240 is 60,000 pesos. So, yung sales per unit is 60 pesos, tas yung variable expenses per unit is 45 pesos. So, 60 pesos minus 45 is 15 pesos. Percent of sales, 100%. Management is anxious to increase the company's profit and has asked for an analysis of a number of items. Required. Number 1. Compute the company's CM ratio and variable expense ratio. So, ang formula ng CM ratio is equals to unit contribution margin over unit selling price. Kung makikita nyo sa book, yung unit contribution margin is 15 pesos over yung unit selling price is equals to 60 pesos. So, 15 divided by 60 is equals to 25%. So, second is compute the company's break-even point in both units and sales pesos. Use the equation method. So, yung pag-compute ng variable expense ratio is equals to variable expense over selling price. So, yung variable expense dun sa given is 45 pesos, tas yung selling price is 60 pesos. So, 45 pesos divided by 60 is equals to 75%. So, third is assume that sales increase by 400,000 next year. If cost behavior patterns remain unchanged, by how much will the company's net operating income increase? Use the CM ratio to compute the answer. So, yung increase in sales is equals to 400,000 pesos multiply by the CM ratio, yung nakuha natin kanina na 25%. So, 400,000 times 25% is equals to 100,000 pesos. Ito yung expected increase in contribution margin. So, fourth is refer to the original data. Assume that next year management wants the company to earn a profit of at least 90,000 pesos. How many units will have to be sold to meet this target profit? So, ito yung equation method. Profit is equals to unit CM times Q minus fixed expenses. So, yung profit is 90,000. Is equals to yung unit CM is equals to 60 minus 45 times Q. Tapos yung fixed expenses natin do sa given is 240,000 pesos. So, 60 minus 45 is equals to 15 times Q. So, 15Q. So, ilalagay natin dito yung sa kabila para ma-compute natin yung Q. Tapos yung 90,000 is ililipat din dito sa kabila. I-add dun sa 240,000. So, 90,000 plus 240,000 is equals to 330,000. So, ang magiging answer na natin is 15Q is equals to 330,000 pesos. So, para makuha natin yung Q, i-divide natin yung both sides sa 15. So, 15Q over 15 and 330,000 pesos over 15. So, cancel yung 15. So, matitira na lang yung Q. Tas yung 300,000 divide sa 15 is equals to 22,000 units. Tapos, ito yung formula method. Unit sales to attain the target profit is equals to target profit plus fixed expenses over contribution margin per unit. So, yung target profit ay 90,000 plus yung fixed expenses ay 240,000 over yung 15 pesos per unit is equals to 22,000 units. So, parehas yung naging sagot sa equation method, 22,000 units. So, next is refer to the original data, compute the company's margin of safety in both peso and percentage form. So, yung formula ng margin of safety in pesos is equals to total sales minus break-even sales. So, yung total sales is 1,200,000 pesos minus break-even sales na 960,000 pesos. Ang makukuha natin na margin of safety in pesos is equals to 240,000 pesos. Tapos yung margin of safety percentage naman is equals to margin of safety in pesos over total sales is equals to yung nakuha natin kanina is 240,000 pesos over total sales na 1,200,000 pesos. So, divide natin to, makukuha natin is 20%. Next is, compute the company's degree of operating leverage at the present level of sales. So, katulad ito nung nauna. So, next is, B. Assume that through a more intense effort by the sales staff, the company's sales increase by 8% next year. By what percentage would you expect net operating income to increase? Use the degree of operating leverage to obtain your answer. So, yung expected increase in sales is 8%. Tas yung degree of operating leverage is 5. So, makukuha natin yung 40%, 8 times 5. Ito yung expected increase in net operating income. So C, verify your answer to B by preparing a new contribution format income statement showing an 8% increase in sales. So pag nag-increase ng 8%, ang magiging sales is 21,600 units na. So, paano nakuha to? 20,000 times 1.08 is equals to 21,600. So, yung kanina natin na total sales is equals to 1,200,000. So, times natin siya sa 1.08, makukuha natin yung 1,296,000. Ganun din dito sa variable expenses. Yung 900 na given kanina, times sa 1.08, makukuha natin yung 972,000. So, minus natin to 1,296,000 minus 972 is equals to 324,000. So, yun yung contribution margin. Tapos yung fixed expenses is 240,000 pesos. So, 324,000 minus 240 is equals to 84,000 pesos. Ito yung net operating income natin. Tapos ito din yung given kanina. Tapos ito yung nakuha na percent of sales dun sa complete dun sa number 1 at number 2, 75 and 25%. Thus, the 84,000 expected net operating income for next year represents a 40% increase over the 60,000 net operating income earned during the current year. So, 84,000 minus 60,000 over 60,000 pesos is equals to 24,000 over 60,000 is equals to 40%. So, last is Number 7. In an effort to increase sales and profits, management is considering the use of a higher quality speaker. The higher quality speaker would increase variable cost by 3 pesos per unit, but management could eliminate one quality inspector who is paid a salary of 30,000 per year. The sales manager estimates that the higher quality speaker would increase annual sales by at least 20%. So A, assuming that changes are made as described above, prepare a projected contribution format income statement for next year. Show data on a total per unit and percentage basis. So a 20% increase in sales would result in 24,000 units being sold next year. 20,000 times 1.20. Kaya nakuha yung 24,000 units. So, yung total sales ay magiging 1,440,000. Yung total sales kanina na 1,200,000 times 1.20. Tapos yung variable expenses is equals to 1,152,000. So, ang magiging contribution margin is 288,000 pesos. Tapos yung fixed expenses is 210. Ang makukuhang net operating income is 78,000 pesos. Tapos yung selling price is 60. Tapos yung variable expenses per unit is 45 kanina. Nag-add ng 3 pesos, magiging 48. Tapos yung magiging contribution margin is na per unit is 12 pesos. So, sa percent of sales is 100%. Then, 80%, 48 pesos divided sa 60, kaya nakuha yung 80%. That's 100% minus 80% is equals to 20%. Next is B. Compute the company's new break-even point in both units and pesos of sales. Use the formula method. The formula to unit sales to break even is equals to fixed expenses over unit contribution margin. So, yung fixed expenses ay naging 210,000 pesos. 240,000 minus yung 30,000, kaya 210,000 over yung 12 pesos per unit is equals to 210,000 over 12 is equals to 17,500 units. Tapos yung formula sa peso sales to break even is equals to fixed expenses over CM ratio is equals to 210,000 pesos over 0.20, which is yung 20%. So, 210 over 0.20 is equals to 1,050,000 pesos. Last is letter C. Would you recommend that the changes be made? So, the answer is yes. Based on this data, the changes should be made. The changes increase the company's net operating income from the present 60,000 pesos to 78,000 pesos per year. Although the changes also result in a higher break-even point, 17,500 units as compared to the present 16,000 units. The company's margin of safety actually becomes greater than before. Margin of safety and pesos is equals to total sales minus break-even sales. Ang total sales is 1,440,000 minus yung break-even sales na 1,050,000 pesos. Ang margin of safety in pesos is equals to 390,000 pesos. That's all. Thank you.